quickly. She is Debbie here is the head underwriter for Atlantic Coast Mortgage, and she spends all of her time fixing what other people break, including me. And what she does is that she is a tremendous resource when it comes to buying homes. And many times what we will do is we will actually talk to Debbie if we have a crazy scenario or we have items that we don't fully understand. And I have a few of those every now and then, especially with my international community. And so she does a great job at helping us decipher this and helping us get set up for success with it. So obviously this is fantastic that she's willing to join us and spend a little bit of time here. And today we're going to be focusing on veterans, but if you do have random questions about other things, then we certainly can go down that path. Okay? Any pressing questions before we get in? All right. So Debbie, thanks for joining us. So I'm over here. You probably can't see me, but I'm over here. As far as we get going with this, it seems like we're always starting out with trying to get a veteran qualified. And that starts with the certificate of eligibility. So tell us a little bit about the role the certificate of eligibility plays in getting a veteran qualified.
Sure. So you have to be eligible for a veteran loan. That's step A. It's the first step that your loan officer will take when doing a VA loan. They're just going to make sure you have enough eligibility. So, I'm not sure the front end as far as when you sign up for veteran, like what they sell you on. You are entitled to a VA loan as a veteran. There's only a certain amount of entitlement. Without going into a bunch of details, basically the veteran back, the VA office is back loans for veterans. Whether you're a reservist, whether you're full-time, active duty, anything, National Guard member, you're going to have a certain amount, and you'll hear the term available entitlement. And that's going to determine how much the VA will insure on this loan. And with VA insurance, what it gives the lender is peace of mind that if the veteran was to default, that they'll be able to recover some money, okay? And I will tell you, lenders love VA, love them. They do have a very broad availability for lending. There's a lot I like to refer to area. So they coach us on lending and say, listen, we want to do loans for veterans. So I'm getting some feedback, Chris. I don't know if you could hear me twice.
No, I'm not hearing an echo on our
Is
side.
it
but
coming through?
no, I don't know where it's coming.
Okay. I'll just slow down. So what VA does is they tell us, listen, we'll back it and we'll do the loan, and we want to make loans to VA members. So the COE is to start it off. It's to tell us as a lender how much that they will give us in case of default.
Okay.
So it's like in my company or mortgage, basically that we should have.
Yeah, we don't have the greatest connection, so sorry guys. It's just I don't know what's going on, but it seems like we're getting a little bit of a garbled voice here. But the certificate of eligibility plays a key role. And what is that guarantee that the VA does then when it comes to, let's say we're buying a $400,000 house? What does that mean to the bank and to the buyer?
So for the buyers, let's say they have, we call it, they've never had a prior use and they've never used their entitlement before. For the buyer, that would mean 100% financing. And to the lender, that means that the VA office will insure for up to 25% of the loan. So in case of default, which is a huge backing, that's even more than a mortgage insurance company would do. So they're fairly low risk though they do default quite often, they're fairly low risk for a lender overall, which is why they like doing them. And I would compare it to a mortgage insurance company. So they're just insuring a piece of the loan in case of this.
Okay, so that's pretty cool that they're doing that, that they're insuring it. Now, as far as you mentioned National Guard and reserves and other things like that, how does that play in with them? Because I know they're not really considered active duty. They're not in the typical scenario for everything. How would that work for somebody who's in the National Guard or reserves?
Sure. So entitlement is going to be based on service in the selected reserve for National Guard, right? Um, and all of it do all have availability, right? So that your funding fee is going to change for reserve and National Guard. So VA is going to charge a little bit more based on service time. But you are still going to have eligible entitlement as a reservist or National Guard member. Um, we do get that certificate of continued service in the selected reserve National Guard as stated in the note. But there is some eligibility there. The funding fees change. That's where the differences come in.
Okay, now is there a timeline where somebody who's in regular military versus National Guard or reserves, is there a different timeline for each or is it the same?
It's, I believe it's the same. I have not heard, I've seen that.
Okay, okay. And then as far as documentation, what would they do for the documentation on providing that certificate of eligibility?
So you would work with, I believe it's a form that we obtain at the time of application, and then we send that in through the web LG. The processor actually does that. I'm not involved in that step.
Mm-hmm.
And Chris, your assistant would probably know a little bit more about what the name of that form is.
Mm-hmm. Yeah,
But they sign it and then we send it in.
Mm-hmm, yeah, and then they have to provide a DD 214, which is a statement of service, in order to be able to do that. Mm-hmm. Yeah.
So she said something about charging more to, maybe the National Guard and the other, type. What did that mean? Charging more about what, like interest rate or?
No, it's in the funding fee. So the question is, Debbie, is what is the difference for the National Guard? What does the charging more mean? And that's related to the funding fee, which is behind the scenes, right? Yeah. So
Your funding fee is charged up front. It's a charge on the loan, and most people finance it in loan, so it's on top. But the charge for every like type of service you have, and whether you use the type of and whether you but that's basically where the VA is gathering their money, right, to do the loan to insure that month for you as a veteran.
So the funding fee is what she's referring to, which is whenever you know how mortgage insurance for FHA has a funding fee of 1.75%, they add that to the loan. It's the same concept with a VA loan. The difference is that it's different for the reservist versus the actual someone who's in the actual active military. So it's like for first use, it's 2.15% for active military, where I believe it's 3.6% for a reservist. And that just gets added to the loan. So just use 100,000 to say, just use round numbers. That means that on 100,000, the actual loan amount would be 202,600 for the first time regular person, whereas the other person would be would be um, 103. So okay. Now I know that are there military benefits or VA benefits for any foreign veteran who may have served in the military?
Yes, there is. You would still qualify for all your benefits as a veteran. So, and then you would still be subject to qualifying terms of citizenship and residency. So, but you are still you don't lose benefits.
Okay.
They're still standard for every veteran.
Okay. So if they became a veteran, let's say they've been like a permanent resident, they decide to join the military, and then they would be able to get VA benefits. Is that correct?
Yep.
Okay.
Mhm.
So that's a pretty cool
Yes.
thing with a VA loan. Okay. Now, moving on a little further, because it's part of the certificate of eligibility too, and we hope this never happens to any of our veterans, but we do know that it does happen periodically. What does a foreclosure do to their certificate of eligibility?
So basically, it's going to use part of their entitlement, meaning now people the certificate of eligibility, it's going to show that use, and it's going to give a permanent amount. It's going to when foreclosure was, and then they won't have enough available equipment possibly for 100% loan, and they may have to put more money down. Now, I have seen had prior use entitlement with a permanent charge that still had enough available to buy another house at 100% financing. It doesn't happen all the time. That's happened.
Okay, so let me change this up a little bit. We're going to change the audio here is really tough right now, so we're going to put this one on mute. Okay, can you hear us any better, or can you say that one more time?
Yeah. Okay.
Can you hear it? Okay. I think it's a little quiet, but as long as we're as quiet as church mouses, we can hear it. So go ahead.
So basically, what that prior use entitlement is going to do, it's going to reduce your total available entitlement, which is going to impact your LTV or the amount of money you have to put down, right? So you may or may not have to put more down if you have a prior foreclosure, right? Because it's going to permanently put on your COE, which is what we were talking about in the beginning, the certificate of eligibility. It's going to put on there and say, well, we have $68,425 that we lost on a prior loan. And so that's now entitlement used, and you only have $65,425 left.
Okay.
So now when we go to do the entitlement calculator, they may or may not, depending on the price of the home, the county, and everything, they may or may not have enough available to do 100% financing. They may have to put money down. Typically, you're going to have to put money down if you've used a lot of prior entitlement on a prior foreclosure, but not always. I've seen it where people still were able to get 100% financing.
Okay, does everybody understand that point? So in essence, if you're buying a $400,000 home, the VA is guaranteeing 25% of that, okay, which would be $80,000. And so if they lost the home to foreclosure, they would lose $80,000 of their entitlement, but that doesn't mean that they can't go out and use the remainder of their entitlement if it was available, okay? Now there's a special calculation that we have to do behind the scenes in order to do this, but that doesn't mean that they lose their entitlement. What it means is that they may not be able to get 100%. Because they have to guarantee the difference between what they lost and that 25% in order for the VA to work. Does that make sense?
And that's permanent,
Unless they restore it, yeah.
unless they restore it, okay.
Unless they restore it. Which, go ahead.
If it's a foreclosure, then you're not going to get it restored. I've never seen restoration. Have you?
No, I've never seen somebody come back and try to pay it off, no.
Yeah.
Go ahead, Eddie, you had a question?
When we say 100%, we need to also ensure that the veteran understand that they need to cover the closing costs.
Yes, so.
Because if you go and tell a typical veteran 100%, as a former military, tell me 100%, I expect 100%.
Yeah, so that's the literal nature of the Army. But you're right. The closing costs or the legal fees for transfer are not covered by the VA. Okay. Okay. So that brings up another question, which is when they're doing this, because they in essence can't reuse it, but they can make up the difference in order to buy something, right? And so that means that if they're buying another $400,000 home and they have enough for X amount left, that they can still not have to pay the mortgage insurance, but maybe put 10% down. Is that right, Debbie?
Correct.
Okay.
That's at 100%.
Now, how does that work for they have a home, let's say in Illinois, and they're moving to Virginia, and they're going to buy here. They have a VA loan in Illinois, and they're trying to buy here in Virginia with a VA loan again. Would it be a similar situation?
It would, and then if they want to sell the home, like let's say they are being required to put money down in Virginia because they don't have enough available entitlement, but they decide they can sell their home in Kansas or wherever they're coming from. If they can sell it at time of closing or prior to closing, we can actually work with the VA office to restore that used entitlement upon sale of the home if they have a one, because you have a one-time use restoration. So there's possibility that they could restore that entitlement and get the 100% financing on the new home.
Okay, so that's a pretty cool
But
thing.
So it's a one time that they can do that?
Is it one time or multiple time they can use that?
I believe it's a one-time restoration they'll allow.
So I'm doing one of those right now.
Yeah. Doing one right now?
Yeah, I believe it's once, but I would say we could get follow-up for you on that because I've not seen, but that doesn't mean it hasn't happened because that happens typically on the front end, and then they let us know as underwriters whether they do have availability to restore, and the VA office can validate that for us during the underwriting process so that you're not surprised day of closing. But they can let us know up front if they have availability to restore.
Yeah, and that usually happens when we pull the certificate of eligibility and other things like that. Is we'll have a conversation if needed to figure out how that's going to work out. And the VA usually falls on the side of the veteran. Is that correct on most of these things?
100% of the time. Mm-hmm.
Yeah. Did you have a question, Linda?
Yes. What if there's a time lapse in between? They use their VA loan and then they sell that house and they have had a couple of other houses, and then they say, okay, I'm going to buy another house, just one, and I'd like to use it again, my VA loan. Can you use it again?
Did you hear the question?
You can.
Yeah.
That makes
Yes,
sense.
you can.
Yeah. So that would be the restoration of entitlement because you would have sold it.
And so would you get the 100%
Yeah.
again?
Mm-hmm.
Okay.
They can use it only for their primary home.
Correct. Yeah.
So if they're pre-qualified for 400 and they use only 200 in buying a house, they cannot use it in buying another one, like an extra house, like a second house.
It would have to be a primary home.
It has to be a primary home.
It'd have to be a primary home. It doesn't mean they can't do it. So that's a great question. So let's bring that up.
So
let's
if
say
they have a VA loan in the primary home, but they want to buy another primary home, so the first one won't be the primary anymore.
right.
How it works?
There are some stipulations with that. So you heard the question, Debbie, where they want to buy another primary, but they're already living. So let's just say this is in Richmond, and they live in a home that they've outgrown, and they want to go to another home. Is that what I'm hearing you say? Okay. So how would that work?
Same way, you'd have to have enough available entitlement to buy the second primary home. It would have to make sense and it would typically, we like to see if you're going to own or occupy, we want to see 12 months of owner occupancy before you do something like that. There is a trend with veterans being business savvy and investing in homes and using their entitlement, which, okay, like if you're going to move into them, I'm all for it. So if you typically I see they'll stay in it 2 years and then buy a new owner occupied home, and that's fine. You can do that. It really boils down to what the first topic was, which was the certificate of eligibility. And do you have enough available entitlement to purchase the next home, right? So that's where it's going to come into play. So, and I've seen veterans have two VA loans, 3 VA loans, because they spaced them out enough, or they were buying in different counties that had higher loan limits, things of that nature. So it is possible. And typically we like to see, though, if you're going to do that, stay in your current primary home 12 months, because you're still are signing a lending document that says, I'm going to own or occupy this home for 12 months. So if they are going to do that, just try to stick with that rule of thumb. Now, we have had things where veterans have been moved or had we've had to override that. And we can make exceptions occasionally based on exceptions, right? Not just I want to buy a new home in the same area. Typically, they're being moved, their post is being moved, so they'll need a new owner-occupied home. But yes, we absolutely can do that for them. It's going to come down to that entitlement piece.
So they can keep that PA loan in both houses in that case?
They
or
can.
They have to refinance the first one?
No, they don't have. Well, they would have to be able to qualify for either both homes simultaneously, or what is the aspect on the rental of the departing residence?
They want 2 years rental income on 2 years tax returns, typically on VA. If you're departing it, though, they'll allow us to offset the PI or the principal, the payment by the amount of the lease, or based on the 1007 in the area, or we can actually get a market rent analysis from you as an agent and see see what the market rent is in that particular area. We can offset the payment only in that case. We cannot use rental income.
Okay, did everybody understand what she said there? Okay, a 1007, that's a shop talk for saying that we have to get a separate document stating from the appraiser what the rentable value is of the departed residence. Okay, and that's actually not a bad thing, because we're trying to make sure that we don't put the veteran in a bad place where they're going to lose all the homes. And so it's really just set up for that. Now, when they do get the income, we're not, if let's say the payment's only $1,200, but they're getting $2,000, we're only going to count the $1,200. So we're not going to use the extra $800 to help them qualify for the new home. We're just only going to make sure that it covers that monthly payment. Does that help? Okay, so that's actually a fantastic question going into this, because there are investment ploys that veterans can do that are completely legit. And I've actually helped a multitude of veterans out of Fort Lee do this, where they go into Hopewell or they go into Colonial Heights or Petersburg and they buy a duplex, triplex, or a quad, and you can actually do that. So what would be something like that, Debbie, as far as going into a multi-unit?
It would just have to qualify under, you're talking about for rental income?
Yeah, so they can qualify to buy a bigger and use it.
Oh, okay. On 2 to 4 units,
Yeah.
on those, right? I don't know if they've just unless they've recently changed the guidelines. Typically, you still can use the other units you're not going to be occupying. But can I get back to you on that one? Because I know we just had an update pushed out to us on that. So,
yeah, that one just might have updated. But in the past, what we've been able to do is use the income from the other residences. So if they have 3 units in the property,
right,
they live in one and get the income from the other 2 to offset the payment. And it's a fantastic way for the veteran to get in and to create that investment portfolio when it's getting going. Very similar to FHA. FHA has that as well.
Now, is that rent based on existing leases, existing tenants, or projected rental income?
That's a great question. Do you hear that, Debbie? Is it based off of?
It's projected. So it's based. So a 2 to 4 unit is put on we call it shop talk 1025 form, and that 1025 form actually includes a market analysis of the rent as well as the value of the property. So it gives a value and a rental amount for each unit separate on the 2 to 4 unit. So yes, that would be what we would use on a purchase transaction for a 2 to 4 unit.
Okay. Any more questions on this topic? Any more questions? Okay, so let's move on to the next one, which is we talked about this briefly, but we talked about foreclosure. But what kind of waiting periods are there for veterans if they do go through ground zero financially?
So there's some exceptions, but typically the rule of thumb is 2 years from either the foreclosure date or the discharge date. Chapter 13 obviously is always a little different because they can be in repayment and still get a loan as long as they've been in repayment for at least 12 months. Chapter 7, they want them discharged for 2 years. And then foreclosure, they want the transfer date to be over 2 years old. Now, there are some exceptions that VA says, listen, we can do extenuating circumstances at the 1 year mark. However, getting a lender to do that, is difficult because there's still a bigger risk around those borrowers. Not to say we haven't done them before, but we definitely ask for more documentation from the customer when that happens. So they are going to have to go through a little bit more hoops than maybe a standard loan would if they're trying to mitigate that particular guideline and go with the 1 year requirement rather than 2.
Yeah, well, what I've seen in the past with that is you have to show signs of recovery. And if they haven't shown signs of recovery, you're just not going to get it done. And what that means typically is that their credit score has jumped way up from when you have a ground zero financially, your credit score goes into the toilet like in the 500s. And you have to show that you're recovered since that time, meaning that you're back into the mid 6s or low 7s and that you haven't had any recent collections, judgments, anything else associated with it. And sometimes in 1 year, that's really hard to do for some people. Okay. As far as this plays into kind of like the next question, which we kind of have is many times we get unmarried co-borrowers coming into this. How does something like that work for the veterans? Are they really traditional? They want everybody to be married, or how does that work with them?
It's definitely more favorable when they're married. So when it comes to entitlement and using your entitlement and you have 2 borrowers and your spouse is not a veteran, but you are a veteran, the VA tells us to look at it as just a veteran loan, 100%, right? So they look at the spouse as one with the veteran rather than a separate borrower. Even though we're qualifying them separately, when it comes to entitlement use, it's considered what we call sole ownership. Even though they are going to split ownership, for the entitlement portion, it's considered sole ownership. So there's no cut to LTV. They have full entitlement. Now, if they're not married and they just live together, which does happen, they're considered joint loans. All right, and they require special underwriting. Veteran and non-vet require it to go to the VA office because they have to split the loan down the middle. The veteran office will only insure half the loan. They will not insure the half that the non-vet is on. The rule of thumb I give people when it comes to non-vet loans, because they're only insuring half, be prepared to put about 12.5% down on the total loan. So that's a good rule of thumb to go by. We can now do, they also call joint loans vet loans. So if you have 2 different vets that are trying to use their entitlement, those will be fully insured, and they will be able to, as long as they have full entitlement, they can use those. But those can actually be underwritten by us. But the non-vet loans where they're not married have to go to the local VA office, and they do take more time, and they only insure half the loan.
Okay, so that means that their entitlement, which would typically be 25%, gets cut in half, which means you would still have mortgage insurance at least on that 12.5%. Is that correct?
Well, you're not going to have mortgage insurance. You're just going to be required to put more money down because the full loan amount won't be insured.
Okay.
So, yeah.
Okay.
So, like, if you typically, like on $100,000 loan, if you had full entitlement, right, the VA office would be insuring $25,000 of that. But because the VA office says we're not insuring the non-vet, they don't have eligibility with us, and they're not married to our veterans, so we don't care about that. We're not giving them the benefit. They're saying we only insure 25% of $50,000. So half the loan. So they're only going to give us half of 25% of $50,000 in case of loss. So what I tell salespeople and agents in situations like this, when you have that non-vet situation, I go into give them the preparation that it typically comes out to about 12.5% on the total loan that they end up having to put down.
Okay. Now that brings up another question, because we have had some veterans, for example, that have passed away, and they have surviving spouses. And I get this question periodically: can surviving spouses use their veterans eligibility?
They can. There are some rules around it. So basically, what happens if they're remarried on or after age 57? They may be granted it to the spouse of an active duty member. It depends on like how the deceased spouse is classified as well. So, like, let's say they're actually MIA or POW. That's a different classification. We have another layer that we have to be met, but there are a few rules. So we can get them done. I would say, Chris, I would go through you on the COE to make sure they would be eligible. We can do them, yes.
Okay. Okay. So that's actually good news, because we do have some veterans that have passed away, whether it's through Afghanistan or whatever else it might have happened, and they do have eligibility that they could pull for their spouses if their spouses decided that they wanted to do something like this. Now, what we would want to do with something like this is, if this is a case and you find this out, we obviously want to do the digging before we get to the promising, okay? Because there are some nuances, right? Yeah. So before we promise, let's dig. But the answer is there is something for that. Okay. Has anybody run into that before? No. Okay. I've run into it at least 3 times, and the first time I was completely uneducated and told them no. The other time I got my hand slapped on that one, and I learned that it is possible. You just have to do the appropriate digging to make sure that they meet the little check boxes for each one of them, and it really is a tremendous benefit, especially for those who gave it all. Okay.
In the case the veteran passed away, but due to cancer or something else, right? It wasn't in duty. Mm-hmm. Would the wife get the same benefits as a veteran?
That's a great question. So if they passed away through non-duty, does that similarly apply?
It does. A big caveat though is they couldn't get remarried. So I mean, if it's immediately after, then sure. Typically that's an overarching yes. But yes, they're eligible for the same benefits.
Okay, so as long as they're still in the widow state or widower state, they could still use it then at that point.
Right.
Okay. All right. Any other
like
questions?
I said, I would never say immediately no to them on the surviving spouse situation. If you have one come up, I would vet each one custom, because they're so unique when we get them in.
Okay, Daryl?
So since we're talking about certificate of eligibility for some of these veterans, like, isn't there like a point system that they have to be in the military or something like that for a certain amount of time to be considered for the veteran?
Yeah, there is.
What is that?
I think it's 90 days of active duty to be considered for a certificate of eligibility for. That's for regular duty, and then there is a period of time. They still have the same entitlement, but it's a different document for reservist and for National Guard. And because they only do it on weekends, they still have to meet the active duty requirements. Okay, and so it's not as linear as with a regular military, but it is a similar timeline.
So if it was a reservist or something like that, they'd have to have 90 days of weekends or whatever probably total to.
Well, it's 90 days of active duty, which means deployment. Okay. Or they would have to have the amount of years necessary to back it up. Usually it's like 5 to 6 years, but that's based off of weekends alone. Okay. But usually there's a document. I don't remember what the document name is. Do you remember, Debbie, for the reservist and National Guard?
I'll find it for you. I don't remember off the top of my head, but I can find it and send it.
Yeah, not huge. Did we answer your question? Any other thoughts before we move on to the next question?
That's the DD 1198.
What's that?
DD 1198.
DD 1198?
Yeah, that's the one.
Oh, that's for the
they do the calculation for you and everything.
Okay. Okay.
Also, but remember, everybody has one of the 90 days of active duty training, because if you go to basic training, that's already there, 60 days.
Okay.
And then you go to advanced individual training, and that's like 30 plus.
Okay.
So the minimum is 90 days.
So it should be
on that part. However, when active duty soldier or active duty service member, let's say, decide to leave the military 8 years, this is not for me. They need to have other than, what is it?
other than honorable.
You need to have an honorable discharge.
Okay.
Yeah.
Right? That has to be.
Yeah, and I've run into that before where we did have a DD 214, and because it was dishonorable discharge, he was not eligible. And so it's
dishonorable discharge. You're not eligible for
no,
VA benefits.
not dishonorable. I mean, he would have to contact the VA to try to get that status revoked or changed, but in essence, in my experience, it's been no. All right, let's move on to the next one. We run into, so now that we're talking a little bit about income, talk to us. There's a special thing in the VA that they look at called residual income. Tell us a little bit more about this residual and why it's so important.
So we like to see as a lender, they have some exceptions to residual income, but we stand by as a lender that we want 120% of residual income for the area based on your household size. And residual income is basically what you have left of income after all of your bills on your, not just your bills, it's really your credit, your housing square footage. We even do it, that's a utilities calculation, and any childcare, any expenses, and that's what you have left. So if your gross income is $5,000 and you have $1,000 in debt, your new PITI, new mortgage payment is $1,000. So now you're at $2,000. So you have $3,000 left. We'll do a calculation of your square footage on your new home to do utilities, which currently is only 14 cents. 14 cents, which is very low, but nonetheless, we do that calculation, we deduct that, and then any child care expenses, and then do you have 120% for the area left over? So every area, so they divide the United States into, of course, Southeast, West, and Midwest. I think it has like 6 or 7 classifications. And then we look at household size and say, what should the residual income be for this area? So let's say it says the residual income for this area should be $833.33 based on a 2-family household, and your borrower has $2,000 left over. That would be well over the 120% threshold that we would like to see. And that residual income is basically a cushion, and it's just saying there's some room even over and above their debt ratio that they have to pay for their bills. Okay. And this is one of those weird guidelines that the VA really likes, and they like to see us justify our lending based on that residual. Now, if they don't have that 120% residual, there are some exceptions, and it has to go through me. I've only done one in a decade, so just you know, we don't like doing them without residual income, but that calculation is just telling us you have some money left over at the end of the month to pay for bills and things of that nature.
Yeah, in essence, what they want to prove is that you have the ability to eat when you're done buying the house. That's really what it is.
Excuse me, what is the person? I'm sorry, I was in the bathroom. What is the percent that you take for the VA loans? Like, I know conventional is like 50%.
Oh, debt ratio?
Yeah.
So the debt ratio, actually, it's well. Let's talk about that. I do have another follow-up question on the child care expenses, but let's talk about that since that came up. What does the VA look at when it comes to debt ratios?
The VA is all over the place with debt ratio. So generally you like to see a standard like 28-41 type ratio if you're doing a manual approval, manual underwriting.
We'll get to that in a second, okay?
Yeah, that's a whole other explanation. But we actually utilize automated underwriting systems that it's done through the computer, and they're analyzing our data input, and they're analyzing the credit. And they will a lot of times allow for much higher debt ratios. We've joked the highest one I've seen is 80%.
So it's an 80% debt ratio.
That have residual income. Again, it was meeting residual income when we pushed it through the automated system. So we've seen some extraordinarily high debt ratios with VA loans. I can't tell you an exact standard. The general rule of thumb is if they're under the standard 29, 28 on the front end and 41 on the back, you're probably good. If their credit is decent, they're okay. Now, if you start getting to the higher debt ratios, your automated approval is going to get more strict. You're risking your approval at that point. But we can do higher. Again, that's where residual income comes in. If you're going to go high in debt ratio, you got to have that residual. That's going to be the caveat. And a lot of times automated, if you're not meeting a residual income and you send it through automated in our system, it will deny it, even if it's a good loan. So that residual is really important, and it'll actually help your debt ratio as well.
Okay, so I want to accentuate what you just talked about here, because this is something I don't want you to miss. It's all about the correct data and the correct data points in the file where they should be. Because if you don't get the correct data points, you're going to get a misread application, which could trigger a denial. Okay, and so here's what I mean by that is if the loan officer doesn't go through the painstaking task of actually calculating residual income, they could get to the point where they have a denial, not because they any other reason other than they didn't calculate it, and they allowed the system to calculate it by itself, and the system automatically triggered based off of what was there instead of them kind of making the data points work. Okay. Now, I want to bring up something here that she talked about was extremely important, which is the difference between a manual and an automated. And I want you to develop this a little bit more, Debbie, because I don't think anybody understands the difference between the automated and the manual. So talk about why you would do one versus the other.
So we love automated underwriting because it spits back a credit decision based on VA's credit criteria. So on their side, they're putting in their risk tolerance, and then we're submitting it on our side with the credit, right? So it's reading the credit and then the data points within the IRLA, and it's saying yes or no based on layers of risk. Okay, and that they're matching up our side to their side of credit criteria and saying yes or no on the credit decision. We like those because as long as our data entry is accurate, VA will buy the loan, they'll insure it, and they won't give us a hard time, right? That gives us the warm and fuzzies as underwriting and as lenders. Now on manual, it's completely up to the VA underwriter, and VA underwriter is held accountable to every data point, every document, every standard within that loan. It's much higher risk. There's much more room for human error, right, in documentation and things being in the file, things of that nature. It has a higher documentation requirement. So on the automated side, it will spit out a documentation level, and typically it only requires a pay stub for your veteran, and it'll ask for maybe prior verification of employment if you don't have a 2-year history at your current job. It may, if we didn't pull in bank statements already, it may ask you for 1 month or 2 months bank statements. Now on the manual underwrite, we're now subject to full guidelines from the VA office, meaning that we got to have 2 years W-2s, we got to have your pay stubs, we got to look at every little single detail on your bank statement. We're going to have to do a much stricter analysis, and then when we write up, so we have it's called a VALA. That's the shortened.
Mm-hmm. Yeah. So let me
loan analysis.
Yeah.
And we actually have to see VA numbers back.
Okay, so let me add some color to this as to why this is so important. Because in the real estate world, once you close, you get to keep your commission. You don't have to pay it back. But if this loan turns into being, we made a mistake and something happened, we have to buy the loan back. It doesn't mean that the veteran loses the house. it means that we have to buy the loan back because it doesn't meet the guidelines, which means I have to repay my commissions. The bank has to do everything to get it back, and then we have to resell it because we can't kick the veteran out of the house, and it gets sold on what's called the scratch and dent. Now, the scratch and dent, what that means is many times we're selling it for, and we're paying somebody $70,000 to $80,000 to take this loan. So you can imagine the risk that happens with it. It's not that the lender doesn't want to approve it. Many times when they're asking for these additional things, they're asking for these things because the risk to the lender is so severe that it makes zero sense for them to fund it unless they can sell it. Okay, and that's the real piece behind it. Now, the difference between the manual and the automated is sold. It's real easy. The manual has so much risk, some lenders won't even do a manual because there's so much risk behind it. Usually when there is risk behind it, we talk about the debt ratio, and they will minimize those debt ratios way down from whatever automated could approve, which in this case we've done them up to 80%. They'll reduce that down to 41%, which now that means that they're buying less home and other things like that. Obviously, we want to catch it ahead of time because we don't want to promise before we can actually provide. And so that's kind of the nuance behind the nuance. Okay, does that make sense to everybody? Okay, good. Did I miss anything with that? Any questions?
No, that's right on.
Okay, now childcare. You brought up childcare as part of the residual. Why? And I know that this is a like a lightning rod here with childcare, because childcare can be terribly expensive. Why do they include childcare as part of the residual income calculation?
Honestly, that's a great question. It's a recurring expense, I guess, for the veteran. I don't know the exact reason why, other than they want to include all expenses that are going to be arduous to the veteran, right? So when they're looking at leftover funds, if you have a $1,500 monthly child care expense, that's going to eat into your ability to repay our mortgage. So that's why they wanted, I would assume that's why they wanted to include it in the residual income calc. Now, if they're of school age, we have some variability if it's a volunteer childcare, but we're required below the age of, I think, 5 or 6.
Okay, so this is an important point because sometimes you may be getting to the point where you're going to get a denial on the loan, and this could be the culprit behind why. Okay, and I'll tell you, you miss as an inexperienced loan officer, this is usually the point that most of them miss, is the child care expenses. And I'll share with you the one I missed at the first and how painful it was, because it was like eating lemons and onions at the same time. Is I had somebody who had almost a $1,500 child care expense. Now they were buying a really nice house, but I had not considered the child care at all. It was my first VA loan. I didn't know anything about it. And so I had child care expenses that I had not accounted for. And literally they were getting ready to deny the loan because of the residual effect of what that was doing. Now, the solution sometimes, and this is where you have to ask the right questions, because you're not always going to have me for a lender to tell you exactly what's happening. So you're going to have to ask some questions. Ask if it's related to the residual. Ask if it's related to childcare, because a solution for this is hopefully mom and dad are within range and mom and dad can actually watch the kids. In my case, that was the beauty of where we were at. They didn't have to, it was voluntary. Mom and dad had actually offered to watch them for the summer and for the rest of the time. And so grandpa and grandma jumped in, mom and dad, for son and daughter, and were able to watch the kids for whatever period of time, and we were able to get the loan closed because of that. Now, it's a little bit of backtracking, but you just want to make sure that if you are going down this path, then it might be resolvable. And I can understand why they do this, because many times veterans get moved into places where they don't have family. And they get moved into places where they have to rely on childcare. And so those are places where you can get into situations like this. Okay? So from the painful standpoint, don't eat lemons and onions, just ask the right questions, okay?
So in the rest of the loans, they don't take childcare.
No, this is the only one.
So is residual and what else? Ask if it's related to the residual and what else?
And to the child care specifically.
Okay.
Because this is one of those hidden gems that can save you a loan sometimes when you're dealing with it, because that's the one that everybody usually misses is the child care, because none of the other loans require it.
Okay. Question.
Yeah.
What about the person is in the military, retired, and get a divorce before retiring, and then the wife is entitled X amount of the land of that soldier is alive for, we call it alimony.
Okay, so did you hear the question, Debbie? The question is related to a divorce of a veteran, and the veteran is now having to pay the ex alimony. How does that work? Did I say it right?
Mhm.
Okay. How does that work as far as residual?
So that's going to be already included in your debt ratio. So that would be included in the residual as well. And that does happen quite often.
Yeah, we actually have to ask for the divorce decree for that and schedule that in, and that's part of your debt ratio. So, yeah. All right. Any other?
And child support, that's a good question. I mean, child support, we do see that frequently now. That all goes in. That's typically not a surprise. The child support piece or alimony piece, those are disclosed on the application and included in the DTI. The child care for married borrowers is what gets us, where they forget to disclose, or they said, oh, by the way, or we see a recurring debt in their bank statement. Who's this $1,200 to kids or kids? You know?
Yeah, and that's what caught me.
That's my child care. And
Yeah.
we have to include it.
Because you forget to ask, and that's what actually caught me, is that they found it on the bank statement because the bank statement shows the exit. Because we look at everything.
And if they're paying if for example the veteran is paying his mom expenses or his parents' expenses like rent, bills.
Okay, so that's a great question. So the veteran is now at this point in time, he's helping mom and dad out, which we have that in the international community quite a bit, where they're helping mom and dad out with paying for X, Y, and Z, whether it's rent, electric, food, whatever. And you can see those on the bank statement. How would that work into this calculation?
I'd want to know an explanation, but I would not include it if it's voluntary, because he can stop that at any point.
Okay.
We wouldn't be required to include it. It would be a risk assessment on each loan. So we would want to see his explanation of what is going on with that. What is that payment? Why is it being paid? Is it your liability? We may even want to see a copy of the lease to make sure that he's not on the lease or obligated. That's where it can get a little arduous and frustrating for customers because we have to dig deeper and ask more questions.
Yeah, that can be a little time consuming. And sometimes they don't think about that kind of stuff when they're coming to us because they think, well, I'm already doing it, it's not a big deal. But that is something that we have to make sure that they're not obligated. If they're not obligated and it is voluntary, then that's a little different. Okay. All right.
How can you make sure that it's not obligated and it's voluntary? I mean, how could be obligated?
So if they co-signed on the lease for the apartment,
Okay.
then they would be obligated. And so we would want a copy of the lease to make sure that they were not on it. Or if they have a car payment, that they're giving them money for a car, that they're not on the note for the car. And so that's what we would look at, stuff like that.
Utility bill or something.
Yeah. Well, court order too, if it's at that point. Yeah. Mm-hmm. If it's for an ex-spouse or something like that. Correct. Okay, and so this is the hot one that seems to cause the most issues in our community, at least, with sellers being willing to accept an offer for veterans. It's related to the appraisal. Now, I know everybody here has questions about that because that's a hot topic here. So, what are the appraisers mandated to report with this kind of stuff when it comes to the appraisal with condition and other things like that? And why is flaking paint the one that's the biggest anxiety point?
So the VA is very particular on their property. That is what they're mainly doing. They're lending on. And VA actually isn't doing any lending. They're actually just insuring. but they're overly cautious with their appraisals. You have to go through a very big process as an appraiser to get through do a VA appraisal, and then they hold the appraisers to a very harsh standard. So they audit them post closing quite frequently, and then they actually hold our individual underwriters accountable as well. So each underwriter that underwrites a VA appraisal has to be approved. You have to go through so many test cases. You'll see people that say I have my LAP or SAR, and there's an extra layer of responsibility, and it's because the VA they're loose on their credit side, but they are very strict on their property side. They want to make sure that what they're insuring is of good value and it's supported. And I will say a lot, I really hope some younger VA appraisers start applying for VA approval. But right now we have a lot of the same players in the market that are VA approved. And the reason why they are so harsh is because they're audited so frequently. I mean, even down to little things that you wouldn't think are even pertinent, are pertinent to them. Now they're trying to automate and get into 2025. They're trying to automate a little bit more to where they're doing risk assessments, like providing them up front, so they're not holding people as accountable post closing. But they are very strict on appraisals, and you just don't have the availability in the market for a bunch of VA appraisers. That's one of the reasons, right? If you have 100 appraisers in your market, typically you're going to have some competing people trying to accommodate you and trying to get the value. Whereas with VA appraisals, there's just not a lot of them in each market. And so with them not being limited on the front end of having availability as a resource, and then on the back end having such stringent post-closing accountability, that's why you have such issues with VA loans.
So explain a little bit more about that risk management thing that you were talking about with the appraiser. What do you mean by that? What are they doing?
So as far as post-closing,
so it sounds like they're looking at the
during
property ahead of time to try it before the appraiser goes out. Is that what I heard you say? They're looking at it to see if there's any additional risk on it?
No. So, well, what they do now is they actually have integrated within their WebLGY system. They run what is called, I think it's their version of a fraud report on the appraised value, and it has a risk assessment number that's assigned to it. So if it has, I can't remember the rating, let's just say it's a rating of 1 through 10. I believe it's 1 through 100, but something of that nature. And then the higher the number, we can do actually we call it a cursory review as an underwriter, and it's good, and you can go through. Now, the lower the number, it's higher risk, and then we have to do a full review on it as an underwriter. So they actually, when the appraiser is assigned and the VA appraiser goes out and does the project, it comes back, and the VA appraiser uploads it to the WebLGY portal. It is ran through this fraud system, and that's when they score it for, they give it a value, and they say, this is a great appraisal, this is not so great appraisal. And then that kind of cues the lender of how to review the appraisal moving forward. I will say conforming to be adopting something similar, so it will be a little bit arduous there moving forward, but
right.
They're starting to, Fannie Freddie are doing that as well, which is
okay.
It does create a layer of extra work.
So let me explain that to everybody so they can understand what's happening. Because in essence, what's happening out in the appraisal world is the appraisals are becoming more and more. Has anybody here gotten an appraisal waiver before on a property? Okay, you got an appraisal. So what you're hearing is what she's describing is that this website, when you submit, like for Fannie Mae and Freddie Mac, we can submit once we put the property in, it spits out whether we get an appraised waiver or not. Now, usually we have to put at least 10% down, And what they do, though, is that think of the amount of appraisals that are happening just in this neighborhood and where we're at right now. And think about all those appraisals that happen on an annual basis. Well, Fannie Mae and Freddie Mac are holding those appraisals and they're putting them into a repository, and then they're putting them into what she just described, and that's putting a score out onto how authentic or real this thing might be, how accurate it might be. Now, the curiosity question is, what does that mean for appraisers? Long term, it's likely that this is going to be like the Zillow's estimate. This is going to be something that takes priority over actually sending an appraiser out. And at some point, they're going to have enough ranges and data points to be able to use this for the most part for some of that stuff. Now, it's not there yet. Yes, but it's not there yet. And so they're still grabbing this information, and then they're putting ratings on this based off of what they feel the appraiser has done compared to the data points that they currently have.
So
Does that make sense?
The quality of the comps, adjustments.
Exactly.
Within a certain range.
Exactly. Now, like for example, I had a report that somebody shared with me a few days ago, and Debbie looked at this. They had $80,000 adjustments on this house. That's not a very high scoring appraiser, because an $80,000 adjustment means you really don't know what's happening in the neighborhood. Okay. And the reason why this got shared to us is they had this appraisal done a while back, and we're doing the refinance for this guy right now. And he's like, why is my property $80,000 less? Well, here's why, is because your adjustments were off that far. So what she's explaining here is the future of what's happening with appraisals, and you have to submit it to this underwriting so that it can score it and let us know whether we need to take another look at it or whether we don't need to take another look at it. Is that right, Debbie?
Yes, and that's called a Vero report for VA right now. That just came to me. But yeah, Vero report is what the system that VA uses to run theirs through immediately to give us report, and it tells us the type of review we can do. And yes, and that's exactly what's happening. And now the market is moving. The point in it is that to give lenders warm and fuzzy that they will that they're lending on a good value. But it does create a bit of a shakeup in the market when things like this happen. So, there's going to be some back and forth, and we may ask for additional comps, and, that gets frustrating and things of that nature. But it's moving that direction across all products slowly, but it is.
So in essence, long term, you may see the role of the appraiser diminish as this goes along. Okay.
In the short term of it now, being competitive going into the market, a lot of times putting enough money down and you feel like you got a great contract price, et cetera, asking for appraisal waiver. So that's not particularly out of the realm of the VA line match.
Right now it is, but down the road it may not be. Okay, Jerome.
The VA loan, is this similar like some of the other loan products in which the value is given sticks for 6 months, I believe?
So does the appraisal follow the property once the appraiser has done the property appraisal? Does it follow it for 6 months like the FHA does?
On VA system, the Vero report, it's just like the UCDP system where they can see the last uploads to their system. So it will compare against prior appraisals. It will give a rating based on, it's going to give a rating based on current data in the neighborhood that's been reported and been sold, right? But it's up, and it's going to give a risk level based on that. But it can see, just like UCDP can on conforming, which is a software they use. They're all requiring that upload from the appraiser, and then it's ran through that software, because we even get warnings on conforming that says, there's been an appraisal in the last 6 months that's reporting a different condition adjustment, which is extremely frustrating for us, because we're like, well, we don't know what that last appraiser said. But yes, it's all being monitored that way now.
But I've always heard the reason that stayed with the property for 6 months was for the benefit of the buyer, so that they would not have to repay for an appraisal. Is that correct?
Did you hear that?
Yeah, so we can reuse an appraisal, yes, one time. if they were to refinance or something of that nature. We can actually use it up to a year.
I think she's referring to a different buyer coming in and buying the same house, though.
Right.
Oh, no, we couldn't use it on a different buyer typically, no.
Well, with FHA, sometimes that case.
Well, when they say, well, we don't want to do an FHA because the appraisal is going to have to stick, what does that even mean then if it's not going to apply to
So,
the buyer?
yeah, so because like with a FHA case number, that follows the FHA for a while, and that appraisal still has merit and values even a few months later. Is that the same way with the VA?
No. In fact, I've had sales originators and real estate agents want to do that, and I've asked the veteran office if we can, and they were literally offended that I would even ask. So
VA's,
no, they won't.
so FHA does that, but what she's saying is FHA will do that, but VA won't. Okay, and conventional doesn't either.
Yeah. Conforming won't either.
Yeah. You have to get a new one. Daryl, you had a question, Daryl?
So I just experienced this with the VA loan. Value came in lower than what the contract price was. And we as buyers had to prove the new value now instead of putting it back on the listing agent to provide comps to the appraiser. So it's now the buyer's responsibility. I don't know if you guys have heard that or experienced it.
It's always been that way. You have to challenge it. It's always been. So when you challenge, let's talk about challenging an appraisal, because that's the question really I think you have right here.
So you're challenging it, but is now the buyer's responsibility.
Well, it is, but it isn't. It's going to come down to how it's been written in the contract. Usually we like to call that a team sport where we get everybody involved to try to get it up and challenge it. And so the listing agent plays a huge role in that. But if the listing agent's playing, Mr. Poo-Poo Face, then sometimes you have to kind of do it yourself to try to figure it out.
So from my understanding is they require the buyer now. So like if I'm representing the buyer, right, I'm the agent, right? I would give him the comps. We would put the property addresses on this form that has to be now submitted to the lender that has to go to the VA.
So it doesn't have to go to the VA. Okay, so let's talk about that, because what you're talking about is challenging the appraisal. And you're correct. Most everybody wants a formal one, not just an email. And so they're sending out a form that they want you to fill out and tell us why it's different and why the appraiser made a mistake in not using one of these versus one of the other ones. And so and correct me if I'm wrong, Debbie, on it, but that's what we're trying to do is we're trying to make sure that we're not we're not saying, well, my opinion is that it should be using the same comps. It should be 600, 1,000, not 575. It's really, what did the appraiser miss? Why should they have used these? Why are these better comps than the one he has? And which one should we replace it with? And so am I correct with that, Debbie? When you're challenging an appraisal?
Yeah, so they're formally considered, they're called reconsiderations of value. Yes. And every, like FHA, VA, conforming, all have their own guidelines when it comes to reconsideration of value. And VA, and every RLC, which is Regional Loan Center for VA, has a different process for the reconsideration of value. And typically what we try to do with those is we try to work with the appraiser directly prior to going through the formal process. So we may, your underwriter may call and say, hey, we have these other comps. We didn't see them on there. We just kind of want to talk through like what's happening, that sort of thing. Or they may call Tidewater if they can't get to the value prior to. So with VA, there's a lot more latitude, I guess. They have a lot more options when it comes to reconsideration of value because you can talk. They're more open about allowing us to talk as underwriters to the actual appraiser. So, and then they also have the over and above that, they have where you can go to a local RLC and say, my appraiser did not do a good job here, and here's why. Right? So they'll let the veteran actually make that, like wave the white flag and say, it is worth this, and here's why.
Yeah, and I've actually had to do that.
Value VA loans.
I've only had to do it once, but that was back in the crash of 09. You guys remember 09? That was a fun time, right? Okay. And the appraiser came in $300,000 low on appraisal. And I mean, back then you were dealing with,
It was a house worth.
yeah, that's how it worked. And of course, we weren't going to. I was working for the builder. The builder's not going to sell you a house for $300,000 off. Just not going to happen. And so they wanted the house enough to where, in essence, they contacted the VA and said, "This VA appraiser is a hack. This house is worth this. Here's the reason why." And in essence, the VA sided with the veteran and allowed them to move forward with it. But it did take a process. They had to contact the Roanoke Center, and work it out from there.
How long would you say it took? Months or?
No, it took about 3 weeks. 3 weeks. The VA in some cases moves very fast, but in some cases they don't move very fast. I know you've never experienced that, but I've seen that. All right, I'm going to let Debbie go. She's very busy with everything else, and we are past our time with her. Any final statements, Debbie, before we let you go?
No, thank you for having me. I love coming to these. You always challenge my skills with all the questions, so I love it. Thank you.
Well, thank you so much for coming, and I actually learned a few things myself here today. So thank you so much, Debbie, and we're very grateful for the opportunity to have you. So, all right, we'll let you go. All right. So let's finish up today with just a little conversation about this. What are your takeaways? What are your takeaways on what you saw, what you heard, what you saw? What do you think?
Don't forget to ask about childcare.
Don't forget to ask about childcare. I can't tell you how important that one is for the VA. It's huge.
I have a question.
Uh-huh.
When I haven't done a VA loan before. Can can the seller pay closing costs for them?
Yes.
And what percent?
4%.
4.
Now,
Okay.
so the VA, they'll do 4% without arguing. If you want more than that, they can do more than that. But it's 4% before they start arguing.
Okay, up to.
How much do you need?
Just to know.
But let's argue about it for a couple hours because that's what it's going to take.
FHA is like
6%.
6% and conventional 3%.
No, 3. It's a sliding scale with conventional, 3% up to 9%. But most of the time it's 3%.
Okay.
Now, here's the thing with the VA that is extremely important, and this is a hack that you need to know because it's this big of a deal. Now, we used this in 2009 to help somebody buy a house. They had a car payment that was obnoxious. Like, I can't tell you how obnoxious the car payment was. But they only owed like $6,000 on the car. We got a seller concession that paid the car off because with the VA you can do that. You can't do it with some of the other ones. But the VA is one of the ones that will let you use the seller concessions to pay off. And that's where you get into the piece on what will they allow you to do. That's why I said, how much do you need? Because if you're using it to pay off their debt, you can pretty much get anything that the seller is willing to give you.
So they just said settlement, they just basically apply that.
Exactly.
And then wipe that debt off.
Correct. And it's paid for by the seller on the seller side CD, but you can see that it's done pretty interesting like that. So repairs. So this in today's market, the seller is not doing a whole lot of repairs, right? Okay, so that doesn't mean that they can't be done prior to closing. You just need something in writing from the seller saying that they're okay with the buyer doing the repairs. And that's a protection for the buyer. Because if they default on it, you want something in writing saying that they're going to get reimbursed for the repairs. And here's the reason why I say that, is I had one agent not tell me that they were doing this, and they had somebody remodel a bathroom that needed to be fixed. They put $10,000 into work in it, and the seller decided to cancel the contract because now he could resell the house for more. And so if you're going to go down that path, there's a very specific way to do it to where you're not getting caught. And I want to make sure that you're not getting caught. But it is high risk. But sometimes in this market, that's kind of what you have to do to be able to get a veteran through the door. Okay. Now, I wanted to show you this. This is my website right here. The reason why I'm showing you this is here underneath the resources tab. You can download all sorts of stuff. You come in, put your name, number, email, whatever you want to do, and you can download stuff, including veteran information that is going to be in here that is really good stuff for them. I have it in Spanish. I have it for investors. I have new construction, and I'm adding stuff all the time to this. So if you do have a veteran that needs something and you need something to be able to help them out, you can come right here to the website and you'll find a lot of this stuff already in here. And what it does is it's just going to take you to my Google Drive, in essence, and you'll be able to see right here kind of what's in, building your credit from zero, funding fee changes, funding fee explained. There's a lot of great things in here to help them understand. And this, how to select a realtor, is actually to help support you, believe it or not, is how to pick it, because it's going to really point to the people who are doing a good job. Okay, that's the whole reason why it's in there, is stuff like that. So this is all important stuff. If they need information, they can certainly come in here and play with it. Now, I don't know how much. Does anybody have just a few more minutes? What did you learn from today? Anything that you can apply?
Everything, yeah.
Do you find a lot of things?
I like the appraisal waiver moving forward that, because so often when we are writing comments, oh, it's the inside, well, we're never gonna get that, we're never gonna get there. So it is nice to be able to talk future-wise, that probably is gonna go that way.
Okay.
And also, I feel like some of the things that we've learned, like when you have loans and they're turned down or they're high risk, or we can ask those questions as realtors, still staying in our lane. What about any type of residual income, child care?
Mm-hmm.
Because we need to know those
Mm-hmm.
from them and set them up for success versus a kick in the stomach.
Mm-hmm. And here's one more thing that you need to be asking. And I kind of briefed over this. Remember the underwriting piece? The automated underwriting piece versus the manual? We actually have to do the automated underwriting before we issue a pre-approval. We do. Every bank is required to run it through the automated underwriting. If you get a pre-approval letter, the first conversation you need to have with them is, did they run it through automated underwriting? And what were the results? Because the results spit out, and that's what we underwrite to. Okay? If they have not run it through automated underwriting, you don't have a loan. You don't have a pre-approval.
So, I'm sorry, go ahead.
No, go ahead.
What will, in other words, thank you for sharing information, what do we need to hear from that other loan officer if it was a deal like that, if it was an agent?
Three things. Three things you have to ask. Okay? Number one, obviously, if you look at credit, income, and assets, right? Okay. Number two, have you run it through the AUS? AUS stands for Automated Underwriting System. There's three different ones. It doesn't matter which one. Have you run it through AUS? Okay. Follow-up question to that, what were the results? Because it spits out whether you have an approval or not. Okay.
So it'll tell you approved or not.
Yeah, it's based off of data points. Okay, so if they got crappy data points, you're going to have a crappy approval. But if they've run it through automated, that's more than half of the country's actually doing. Okay, so you followed up, what were the results, right? And then the last follow-up, which is, this is the third question, do you have any additional overlays that may cause problems for this buyer? Those are really the three main reasons that the loan gets denied.
So that's even great to know as a listing agent.
Yeah.
When you're receiving those letters, and then when you do have clients come to you and say, hey, I'm already pre-approved, and we look, and then we call the lender and ask those very specific questions.
Right.
Mm-hmm. Yeah, always call the lender.
Yeah.
Mm-hmm. And those are the three questions you need to ask with, what were the results, in essence. Okay.
So when you ask that question, if they've been through AUS, they've been approved or they haven't been approved.
Mm-hmm.
You just said if they are approved, sometimes the data points are weak, right? And so how do you peel that on your back another layer?
So I can manipulate data points.
Okay.
And that's where you want to make sure that they looked at credit, income, and assets. Because if they've got the credit, income, and assets into the file correctly, you've got a 90% chance that you're in good shape. Okay, credit, income, and assets. Have you run the automated underwriting system, and what were the results? And then number 3, do you have any overlays? And those are the most important questions you can ask, whether it's to a buyer that you're going to start representing and put in your car, or whether you're receiving a letter on a listing stating that this person's pre-approved. Those are the questions you ask.
And only 2 results, either approved or declined, anything in between.
Yeah.
Concerns.
Yeah. Right? Yeah. What you'll do is you're going to take them, you're going to shock them, because nobody asks these questions. Nobody asks them. You're going to shock them, and they're going to get defensive, because now you're asking them if they've actually done their job. Okay, because that's
if you receive a pre-approval letter, means that they already
they did those 3 steps. Yeah.
And now we're saying, did you?
Right.
Are you sure?
Yeah, but here's the thing: is that's all shop talk. That's what we have to do internally, but it's going to tell you pretty quickly whether they've done it or not. Because if they're going off of stated income, if they're going off of, you see what I'm saying? Because I get a lot of times people that come to me who are self-employed, who report $20,000 worth of income, and they're trying to buy a $600,000 house, and they've already been pre-approved by XYZ online lender.
Oh, but it could be for like a bank statement loan.
Maybe, but not at a 4% or 6% interest rate. Okay, that's 13% is what we're talking about. And so now all of a sudden I'm like, well, are you sure that you've been pre-approved? And many times the answer is, yeah, I think so. And so that's where you have to start asking the questions, because if they're unsure of what's happened, you probably need a second opinion.
Well, us as realtors, we ask these questions, and we only have so much power but to take their word at face value, right?
Yeah.
So what could we do to scrutinize that anymore?
Pretty much you can't. You have to expect adults to be adults. But at some point in time, if you can ask those 3 questions and get your spidey senses going, you'll get a good idea whether you're dealing with somebody who is or who isn't.
Are you gonna have all this on your YouTube channel?
I actually have it on my YouTube channel.
I want to watch the replay and take it really.
Yeah, this is going to be on my YouTube channel. The first part, the audio is probably going to be a little rough, but it's going to be. So I want to finish today. I'm going to turn the radio or the thing off while we do this. These are objection cards. Is anybody? Oh, I'm sorry. Go ahead.
No, I just had another highlight. I think it'd be beneficial to share with the group. Another question that you guys should be asking the veterans is if they have any sort of disability.
Okay.
Especially the ones in active duty, because some of them have record service when they're serving the reserves or national. They receive